So this is what we have seen yesterday. So the buyer did all his techniques to reduce his loss. Now we'll see the other side, how the other person will be able to hedge his positions. Who's the seller? So we'll be discussing about short spreads. A buyer has sold a call option, bought a call option, which means somebody would have sold to him. Similarly, for a buyer who has bought a call option, somebody would have sold him a call option. He is now buying a spread. Okay, the strike prices are increasing along this direction. He is buying a spread. That means somebody would have sold him a spread. Now the spread width is say 100. If the buyer is having a risk of 20 rupees, that will be the reward for the seller. If his reward is 80 rupees, that will be the risk for the seller. So just like opposite positions, his profit will be 100% loss. Now let us discuss how the seller will be handling his situation. What is his payoff structure? As we see, the moment he sold a call option beyond the strike, his P&L will start decreasing. So he tries to hedge. What happens? Immediately his loss is getting limited. Same which we discussed yesterday. So rotate down, go down, rotate up. This is your payoff structure. Now, how he will hedge? He will get a credit. So the same strike which he sold his spread. Now let us say the spread width is 200 or 100. He got 30 rupees credit. So remaining 70 is his loss. Okay. To balance it, similarly, he can sell some other spread here. Okay. So what happens when price decreases, and if you sell a put option, rotate down, your P&L will start going down. Again, it will continue to go down further. To limit your protection, you buy a put option. Now this is nothing but a call spread sold here, put spread sold here. So this is nothing but an iron condor which has a very good width of payoff, and at the same time you are hedged in both the directions. This condor is a bird. It has very big body and big wings. That's where this bird iron condor is being derived, since it is being stable. So what are the variations we can create? Standard books will say some criteria like do a OTM call, then buy a OTM call, like that. It's not necessary. Concept is you sold a strangle. When you sell a call and put, it is a strangle at the front. You hedged by long strangle. That's all. A wider strangle. So now what are you can change? You can shrink it. You can grow it. You can increase this distance. You can increase this distance. Or this triangle width itself you can increase. So these are the parameters. When we backtest, we will be changing all these things and put all combinations and check, and whichever is giving good result, that only we will be using for trading, deploying the capital. So basically the idea here is you get profit when Nifty stays between. This is where your P&L starts going down, so you are expecting Nifty to stay within range. How much probability is there for Nifty to stay within this range? That you can use your technical skills also. We'll understand some basics for this. Now, what is the meaning of this 28%? It can move 28% up or down. 15,000. 28% is 4,500 plus or minus 4,500 in 1 year. What is this daily volatility? 1.5%, which means 150, 15,000, 1% is 150, 55.5 is 75, 225 rupees points up or down. So NSE is displaying this information. So it has some purpose, no? That's why it is displaying this information. But what these persons who are trading, who are very close to strike price 14,867, I am referring this. He is thinking only 20% it will move in a year, 17% he will move in a year. India VIX is at 20, it is telling 20% move in a year. So perception of each individual is different. So what we can do, we'll try to understand what is volatility. It is nothing but price fluctuations over a period of time, how much it can oscillate. The bigger the magnitude of oscillations, the bigger the volatility. The smaller volatility, which means it is range bound. How to assess it? So if you see, you can take the ATM, CE, IV and PE, take an average which is 18.2. In previous slide we saw 17 and 19.6. You can take it an average and you can calculate monthly, weekly, daily. Similarly, you can do it for futures. You can do it based on India VIX also. So how these are related? If you do square root by 12, you get monthly. Square root by 52, you get weekly. Square root by 365, you get daily. Simple formulas. Just to divide 28 by square root of 12. That's all. If you divide by 12 months, what will happen in 1 month? 5% can happen in 1 month. 2.5% can happen in 1 week. And 0.95% can happen in 1 week. So this 1.5% which was displayed in the NSE site, no, 2 slides before, how we got it? We divided by 365. So it is matching. So what are these values telling you? One fellow is telling it can range to 15,648 to 14,085 from 14,861. So which is nothing but how much points move is 800, right? 800 plus or minus. In 1 month, the prediction is it can go 800. Just mathematics. But if you see weekly, 250 and 500. We are at 14,867. It is how much? 867 and 500. Approximately we keep it 500. It is around 367. So in 1 month, 800 points. But in 1 week, 350 points. So actually how it should be? 1 month 800 means per week 200. Next week 200. Next week 200. Last week 200. It is not like that, no? So weekly, if it moves 350, then next week 350, next week 350, 700, 700, 700, 1400 it should move in a month. So monthly saying 800, weekly saying 350. If we project weekly data on monthly, we should go 1400. If you back project monthly data on weekly, you should move only 200. These are all maths, but what happens reality is something different. So what we understand from this, in first week you move 350, that means you covered almost how much? 800 is your monthly and 800 is your monthly target and 800 is your monthly target, but your weekly is 400, 350. Now next week you completed 350, so total 700. What happens? Almost you reached a monthly target, no? So what we have to understand is every move has a time constraints. If the time constraint is more, beyond that if you overshoot, then you will have to pull back. Except for more news or some events and all, we have some exceptions. Other than that, the point we have to understand is, if the daily range is 14,867, 15,000, how much? 150. So in one day 150, in 1 week it is 350. 14,867 around 250. How much is this range? 400, right? So if your daily move happens very fiercely and you reach your weekly target within 2 days or 3 days, then you can expect some pullbacks. That's all. This is all projections of Nifty's through various methods. For all the things, the base is only this monthly, weekly and daily AB. So how do we use it? If you know Nifty is going to range bound between 16,000 and 13,500, you can sell call options beyond that. If you know Nifty is going to stay range bound between this week 15,500 and 14,300, then you can sell beyond that. If you know Nifty is going to stay range bound between these levels, you sell beyond that, but problem is your unlimited risk. So now what you do? Hedge it. With this background, we will come to use iron condors. So now we can use a flat model just for analysis. So 200 point spread. So how do you take it from this table? Let us say Nifty is at 14,762. This is a previous data. 14,500 spread, which means 14,500. 200 point spread is 14,300, which is 231, 168. So 63 points is your spread. How do you get this 231 minus 168? If you don't want to subtract all this, yesterday's concept you can use. Just you can start thinking in spreads. 100 point spread is 32. 200 point spread is 32 plus 31, 63. Simple. And still, if you want to understand the meaning of difference in spreads, 32 minus 31 is 1 rupees. That means if you roll over by 100 point spread away, your cost will be 1 rupees. If you shift your 100 point spread from 14,400 to 14,700, so the difference is 32 minus 41, 8. 41 minus 40 minus 1, so 7 rupees you may get. So this we will dwell more upon when we come to adjustments. Now we understand that when we move a leg from one position to another position, our additional expense or income will be 32. Now if you move a spread from one position to another position, then you use the difference in spreads. Later when you do strategies like now how you hold portfolio, 500 Tata Steel, 100 JSW, like that once you have good understanding, you will be having portfolio like 300 wide butterfly 2 numbers, 200 wide ratio spreads 5 numbers, calendar spread 2 numbers. Like that you will be having portfolio will be like that. So that time you may not have that much time to sit and subtract each and every leg and think. So understanding of spreads is essential. Now 63 rupees is your 200 point spread. Another 200 point you short at 14,900. Totally it is 153. So if you do a 63-200 spread, what we learned yesterday, 63 is your credit, one remaining, 63 minus 200, how much it is? 137 is your risk. Here 109 is your risk. But when you do both these, 154 is your risk and 154 is your credit and 46 is your risk. Anybody wants to say something? We can continue, no?
Dhananjay troubling you in between. There's a lot of disturbance coming from the
Kamaljeet sir, your audio is intermittent.
Is my voice clear now?
Your voice is clear, Dhananjay sir. Kamaljeet sir was telling something, his audio was intermittent.
Okay, no problem. So now we will understand that when you do an individual spread, 63 is your maximum profit, remaining 137 is your risk. When you do an individual spread, 91 is your max profit, 109 is your 1 minute. Bala, hello. So now there was some noise, it seems. Now I have just adjusted. 46 is your net risk. Actually, we have reduced it by a large amount because of this 9 condor. So next we will have some payoff graphs, some examples for you. This is what we discussed now. 46 is my risk, 153 is my max credit. There will be a break even here. There will be a break even here. So this range, if Nifty expires, you will get profit. This is a 3:30 p.m. payoff graph. Now let us see what happens in reality when you do it. We'll have some simulations today. So the payoff graph will be like, slightly it will be like this on the T+5, then slowly it will increase like this, then on expiry day exactly it will come close to this. Now let us do some other variants. I will discard all the markings. What I am doing is slightly I am trying to change the spread width. For example, what I have done here is I have increased my sold strikes. 14,350 is the first break even. Now I am trying to widen my break even. How? Whatever I sold here, I sold here. Instead of this, I sold here. I sold it far away. Now if I try to make it still, I have sold it more wide. But if you see this region, from here my profit starts reducing. So from here to here, this region I can make it short or I can make it long. How? By adjusting the width of the spreads. So as and when I move my strikes far away, my payoff graph gets widened, but my profit comes down. So what I did to retain my profit, I still widened my sold strikes, but I have widened my spreads. So what happens here? My risk becomes increased. Now whether the probability of this risk being booked by us is second question. Whether it will reach or here is next question. But as of now, we understand that when you try to compromise in your profit or when you want to be more safe, you take wider, but you lose some profit without changing your width. your risk alone will increase. At the same time, when you want to be very safe and do far trades, and you intentionally increase your width also, your risk reward gets affected. What is the margin required? You can go to Trade Genie. Just this is I took in Trade Genie example, not live trade. I just calculated this. It's having a total margin of 62,000. So actually, if you sell individually, it will take 117 and 120,000. So net is 2.38. But due to this hedged margin, you are able to get it at 62,000. Just simple. That's all. This is the benefit which SEBI or NSE gives. Tomorrow it may take also. It may increase or decrease also. You can safely consider 70,000 because daily MTM also it will be accounted, which we learned yesterday. Now coming to the next variant, instead of increasing the widths, keep on increasing the widths, what we do, completely reduce the widths and make the spreads very close to each other with 0. So same I will do. I am selling a call put, rotate down and rotate up. Simple. You can remember this pair structure. This is called ironfly. So here nothing, very simple. What is your protection distance from your sold strike of call and put? That's all. The short strike call and put width, this I will make it as 0. Parameter 1 will become 0. But you can have this short strike call and put, this width is 0, but the strike you can deploy it at different place. If you deploy it here, your payoff will be like this. If you deploy it farther, your payoff graph will be like this. So we will see a small example. 14,700 we deploy the ironfly. 193, 193, 144. Almost how much we get? 337. We deploy a 400 points wide. That means from 14,700 your hedge will be at 1,500 and your 14,700 your next hedge will be at 14,300. So 400 points wide spread. This one, this one, this one. So you have almost a wide range. Let us see how the payoff groups like. So this is the payoff. You have a 63 points risk. And what is the difference between ironfly and this iron condor is your peak profit is made at a single point. But whereas there you have a constant profit over a wide range of movement in Nifty. So this is the difference between that. Now I will shift the ironfly slightly. I will shift it. So you see I will deploy it at 1,700, 14,700, 15,000, 14,700. I will deploy 3 ironflies and see what is happening. So the next ironfly is which is deployed at 15,000. So 15,000, 400 points this side, 400 points this side. So if you see the peak is 337, here it is slightly less. This is a non-directional, but once you offset it, it becomes directional. That means if Nifty is here, you get max profit, but now you expect Nifty to move here and then stay there. That means you are directional. Directionality is assigned by the strategy we deploy. Okay, so you can read books theories which will say non-directional, but if you want, you can pin the ironfly at the different strikes so that you get your directional flavor to your strike strategy. So these are the various risks and rewards. When compared to others, no, you see almost 1:4 is the risk reward. Even if you catch 200 also, which is coming around 1:3. So how the payoff graph will be? Same, that bending effect. You will get slowly, like this hill will slowly grow and it will come to this at the time of expiry. That's all. Now, what is the problem with this actually? Yesterday Viral sir also was asking. What I have done is, I have kept Nifty at, I have taken 15,000 as my reference and I changed Nifty values from 14,000 to 16,000. Okay. When Nifty changes from 14,000 to 15,000, what happens to 15,000 CE? That is the question. Now we are going to assess across days. That is what I will be telling. No expiry day graph, you will leave it, you will see what is the reality. So what this says, 14,600. My pinned strike is 15,000. Okay, my reference is 15,000. 400 points ITM option is trading at 0.75 delta during the start of month. This is the meaning. That means if Nifty moves 100 points, it will save you or reward you by 75 points. But as time goes, at the end of the month, it will give you 95 points. If Nifty moves 5 days before expiry, Nifty moves 100 points, it will give 95 points. Next, this is a deep ITM. Okay, my reference is 15,000. I am taking 14,600 CE, which is 400 points ITM. Now slightly ITM, 75, 63. Now here it is 95, 79. Suppose you sold this and bought this. What is the meaning? By selling this, if Nifty increases by 100 points, you will lose 63 points. But here you gain 75 points. So how much is 63 and 75? 12 points. So the call spreads seller will lose 12 points. The 12 points will go to call spread buyer. That's all. Simple. This is the interesting one. ATM. That means let us take month starting 15,000, month ending throughout 15,000, and you are also buying 15,000. Every day when it goes 100 points up, 100 points down, and daily if it closes at 15,000, then your stability at any day, if it goes any side, upside or downside, if you have sold call option and put option, your profit and loss from both the options will be helping each other and you will get no loss. That means the nature of the option doesn't change throughout the month. Now, what is this 0.5 delta? It is at the money or the nearest time. If Nifty is 14,600 today, 14,600 is at the money. If Nifty is 15,000 on 15 day, 2 weeks later, 15,000 will have 0.5. So this is that train effect which I told. This 0.5 which you see will be sticking to the one who is close to the spot. What happens to OTM strike? 37 points it will protect you. So in our previous slide, we have sold 2 call options at the center and we have protected it by buying far away. These are our protection people. So guardians. This is our security. So these people will save us. If Nifty falls by 100 or gains by 100, they will save 37% of the move, they will save us. But as days they go old and they become weak. So they will save only 21% of the move. 100 points if Nifty gains, they will save you by 21 points. But at the end of the day, what happens if the person doesn't reach the target, he is not getting the reward, no? Similarly, this person will become almost idle. He will not react at all as we go close to expiry. This is further OTM option 26.05. That means 100 points move also he will react only 5 points. So this is what we have to understand how the property of an option changes as we go close to expiry. So horizontally we have analyzed. Now we will analyze vertically. Okay. Let us say we are at 10 days. Nifty is at 14,300. Okay. You purchased 15,000 call option. That means 700 points OTM. That means you are in blue line. You are having a blue line OTM option. Suddenly Nifty moved 200 points. The person who gave you, how much is this? Around 0.1, let us keep, or let us keep this also. 5 points who protected you, he will start rewarding 21 points. Now another 200 points Nifty moved, almost close. We are 400 points, it moved. From 14,300, if Nifty came to 15,000, for every 100 points he will give you 50 points. If it became in the money, it will become 79 points. So a person who was giving just 5 points for every 100 point move will give you almost 95 points. That do on this expiry, you see, magics will happen. That's the hero zero option which is happening. Something which has 5 rupees in Bank Nifty is going 300 rupees. No, this is how it happens. Let us say Bank Nifty is 30,000, 33,000, 33,500 call will be at 5 rupees in morning. Every 1 hour, 1 rupee it will decay. Suddenly Bank Nifty moves 500 points. This zero will become hero. He will start giving 50 points. From there another 100 points and it expires. It will become like in the money delta. But who is changing all this? That is the gamma which we discussed yesterday. So all these concepts are embedded with this graph. So vertically when you analyze, you can understand the effect of gamma, and horizontally if you analyze, you can understand the effect of theta, delta decay, delta diminishing also you can consider. So this deserves quite some time, so I spent some time in explaining this. This is a further OTM option. Just it is. So that's all about all these time which we discussed. No, it's all about single expiry. Now we'll come to horizontal spreads, which is called calendar spreads. So what is calendar spreads? You take 2 expiries, one is monthly, another one is 2 monthly. So here you sell a near call option and you buy far call option. Let us say 15,500. So in a calendar what we see, 2 months we can see at a time now. Present month, current month, previous month, past month, like that. Similarly, you can have 2 legs, one in this month, one in this month. Now what sign we have used here? Plus. Plus means credit. Buy. That means one lot you have buy. Minus means one lot you have sold. When you buy, you get debited. When you sell, you get credit. That's what we learned yesterday. Now let us see the price. 1 month time if you ask 82 rupees you should give. 2 months time you should ask 210 rupees you should give. You go for a hotel, you ask for 1 day lodging, they will charge you. You ask 5 days, they will ask more money. No, like that. If you borrow more time, now Nifty is at 14,800 something, right? 700 points move. This fellow is telling in 1 month it will happen. This fellow is telling 2 months it will happen. So he is giving 210 rupees, he is giving 82 rupees. So both are betting the same distance but different timelines. All the strategy which we discussed, no, iron condor, ironfly, all those had same time limits but different distance. This is what we have to understand. Now how they will behave different? See, this fellow, if he increases, in the previous slide what I have showed, as time goes, the strength of the option to fight against price movement will keep on diminishing. So this fellow will able to fight 35 points, 34% he will able to hedge. He will hedge only 22. But theta wise if you see, this fellow is giving slightly higher. Usually it will be more higher. Now we are in low IV. So 4.43, 4.37. That means for 1 day it will decay by 4 rupees. Tomorrow it will become 205. Day after tomorrow it will become 200. This will become like that. This also will change. Gamma, okay, is high, but because why this fellow is high when compared to this? This is 4, this is 5, no? 25% higher. Why? because he has to suddenly make this 0 to hero. So he will be always more active as we go close to expiry, like God will come and give one boon and suddenly the beggar will become a rich person in old movies and all you can see. Like that, this G for God is G for gamma. This person will come at the last minute, make this 82 into 500 also. This gamma you can't react like this. Now coming to Vega. This is what you have to understand well. Long dated options have more Vega, near dated less Vega. That means when time is more, you don't know what happens. So your uncertainty or fear is more. When time is less, you know what will happen in next 1 week. You don't see any much certainty. So your fear is less. 12 rupees, if VIX increases by 1 rupee, 1%, 12 rupees you will gain here, 21 rupees you will gain here. This is the explanation on Greeks. Now coming to this, we have short here, we have long here. That means you short 82, you bought 10, 210 minus 82 is how much? Roughly you just keep it in your mind. 210 minus 82 is around 130. So 130 rupees is net debit. So in this strategy, 130 rupees is a debit. Debit means loss. So how to minimize this 130 to 0? That will be our objective. What is the objective of this strategy? How we will gain from this strategy? Simple. If Nifty moves by 200 points, this fellow will give you 340 into 200, 68 rupees. This fellow will give you 200 into 22, 44 rupees, 63. You will gain. This difference is how much? 22, 34. 12 points, no? For 100 points, 12 points. 200 points move, you will get 24 points. That's all. Simple. If the same move happens 2 days back, then because of this you won't get anything. And suddenly if any 1 day VIX drops also, that's a jackpot for you, but it will affect both. Then why are they having this option, this type of strategy? Can you say any one situation wherein you will fear more for the next 1 week, but later everything you will be comfortable? For example, tomorrow is election or next week is election. Till the election results are announced only, you will be afraid who is going to win or which is going to be, how the index will be affected. Similarly, tomorrow is Infosys results. What will happen? They will post good earnings or not, uncertainty. But after the result, you will be free. So there are situations where your near-term fear will be more and far-term fear will be less. That time your near-term IV will be high and far-term fear will be less. This is called IV backwardation. In such scenarios, it will be preferable. However, in normal scenarios also, you can use this. You don't lose much actually. But these are all the risks and properties behind this strategy. If you understand this, you can handle this, no problem. Even you can take one ironfly and mix 2 spreads also and you can handle. All these things we'll discuss. First you should, basic things you understand is horizontal spreads means one spread here, one leg here at different expiries. Now same thing, 15,500 is here, 15,000 is here. If you buy this and this called vertical spread. See, it is vertical. If you buy here, it is horizontal. That's all. So now we'll do the same thing what we did in, this is a small mistake, wait, I will correct this. It should be put. Okay. And here I have given a CEPE, both should be PE. We can ignore this table, but put calendar spread is the same thing you can do. If price falls, you will get more profit from your long dated option and less loss from your near dated option. This is put calendar spread, call calendar spread, that's all. The same thing, instead of doing in the same strike, if you do it in different strike, then it is called diagonal spread. That means you will be buying here. Instead of spending so much rupees, you will buy at a lesser rupees. Similarly, for calls, you will sell a call here and you will buy a diagonally. You will buy a call here. This is called diagonal spread. If you do both diagonal call and diagonal put, then it is a double diagonal spread. These are all just variants like how we learned condors. So now we will see a small adjustment so that you know how to handle situation. So let us say Nifty is at 15,500. We can just bring down this call. So what are the things that will happen? 15,500 is there or here. Nifty falls by 200 points or 100 points. What will be the premium? If it falls by 100 points, this 82 will become 61, correct? Because if it falls, the premium will decrease. So for 100 points away, 61 is the whoever was let us say Nifty is at 15,000. From 15,000 it was 500 points away. So 15,600 was 600 points away. That means 15,600 is trading at 61. Like that you should not understand. 600 points away option is trading at 61. 500 points away option is trading at 82. If Nifty falls by 100 points, 15,500 will be 600 points away, correct? Let us say Nifty falls from 15,000 to 14,900. 100 points it falls. So this fellow will become 100 points more far away. So he will trade at 61. So 82 to 61 is how much? 21 rupees. So by rolling over from one spread to another, you will get 21 rupees credit. So what is our net debit across this? 210 minus 82, how much we got it? Roughly 160. 130, right? 130. In 130, now by rolling over, we got 20 rupees. Like this you keep on calculating. If your cost becomes 0, then this becomes risk free. That is how we'll imagine, but it will not happen like that. What happens once this fellow is far away, you keep on rolling. The moment Nifty jumps back, no, that gamma will come here and make this fellow hero, and he will behave like future. That means this will become 210, this will become 210. You will get net 0. So initially your debit was 150, and when you sell it, your debit is 0. So 150 is your buy cost, 0 is your sell cost, which means we lose. How to escape from that? Just keep on pulling this fellow also nearby. If this fellow is far only, he will not protect you. So keep him also nearby. Like this you can think, I have done a post-mortem of what is inside everything like this, and I have shown you how they are getting affected as time passes. So you can build your own adjustments. There is one book I will share in group also. One of the books I read. There are other books, websites also. Option Strategies by Budwick. In that 4 different type of adjustments are given for handling a call calendar or put calendar. But when you are reading the book, you just keep in mind that why they are doing this, what is happening behind. For that I have just explained you. This will help you to read books and understand more faster. That's all. That's the objective of this presentation. So now coming, when we take any strategy, any positional option strategy, we will have some questions. Should I to hold till expiry? For this question, you ask some set of questions, you backtest, and then you get clarity. If we hold till expiry, what happened in last 2 years? If I exit in 10 years, what happened in 2 years? If max loss is 10,000, but I am now at a loss of 5,000, should I exit? Again you ask what happened in 2 years. For all the things, you just ask what happened in past 2 years, why that strategy gave loss, which legs became weak, is there any way to strengthen that, can we make any adjustment? if we make adjustments, do we get profit, or without adjustments we get profit? Just take 2 years data, do this simple exercise, you will get answer. So finally, what happens if VIX increases? And as you travel through this journey, there will be some ups and downs of losses and profits when compared to the max profit and loss, which is mentioned in the payoff. So this will help you how much capital you should have as a reserve. So now coming to the next part, when I tell risk, it is different for a working person, it is different for a retired person. So let us say this working person, he has got 15k max loss, but his life expectancy is more. He can earn it because he is working. But what about this senior person? He is retired, 70 years, no job, surviving on pension or from FDs. For them, the risk is different. So strategy will tell 7,000, 5,000 loss, but whether everybody can take that risk? No. I was discussing with one senior person. He was having a good lot of Reliance. Several years back he has bought 500 quantity or more than 500, more than 1 lot. I was just asking, why can't you short a far OTM call and earn some 5,000 to 10,000 per month? So he was telling, he was 70 years old. That day only he told me, I have lost enough. I am at my 70 years, so I don't have any proper expectancy of getting a job or earning remaining years. So at least if I save or keep safely what I have, that's more than enough for me. So that's the point where I started to think how to develop hedged safe strategies. I kept on searching, so still I am searching. It will be good if we can find, but whatever we have, if we improve itself, will get to be targets. So this is what I want to explain you through risk appetite. Now coming to the margins and returns. If you are putting a bank nifty 3 rupees to 300, it went last week, no? Expiry. So 60 rupees will become 10,000. Why should I invest 61,000 rupees in an iron condor and wait for 1 month and I don't know how much returns it will give? You see what companies are doing. This is Reliance payoff, like Reliance output over the years. So here is not visible, it's here. What is their profit margin? 17%, 19%, 20%. What is their return on capital employed? 12%, 10%. What is the return on invested capital? 17%. There may be so many difference in this, but whatever you see this here, no, we can see maximum 17%, 20%, 25%, that's all for 1 year. He is having 1,000 crores or 2,000 crores or even 1 lakh crores, no problem. Even big companies are operating at a return of 20%. This is Asian Paints, 15%, 32%. So annual returns, if you make 15% or 32%, which means monthly 3%, is itself is 36%. Monthly 2% is 24%. If you have 1 lakh and if you make 2,000, then you should tap on your shoulders and you should congratulate yourself. And if you are consistent, then it's very good. So have conservative return expectations on the market. When compared, I am just targeting on positional hedged strategies only. There is an intraday method, very good methods are there, which we cannot compare with this because its potential is totally different. So what is the margin for our ironfly? If you didn't do anything, it's 3 lakhs, but if you hedge, it is 81,000. So for 81,000, if you get 1,600, how much it is per month? 2%, correct? If you get 5%, it's 4,000. Just you have some reasonable target. Yesterday, one of our friend was asking, I got 50% of max profit in ironfly. Shall I book it? I will tell close your eyes and book. Enough. Next month you can take. As long as you have capital, you can trade. So, moment you see profit, book it or hedge it or lock it. Do some strategies to at least to just book that, hold that profit with you. What is the margin for spread? 59,000. Yesterday we did so many studies on spread. For saving that 300 rupees of loss, I spend 59,000 rupees and make that loss as 150. So 300 is 22,500, 75 lot size. 150 is half of that. I am deploying this much capital because we may get a question after attending this presentation whether it is really worth to deploy this much capital. The presentation was very good, but capital required is too much. Now we come to the part backtesting. You take any strategy, choose the strikes, ensure that it is hedged. All you have to ask is how many days before we should start, what adjustments to be done, when we should do, when to exit. This questionnaire you have with you. We will try to do some backtesting now. Meanwhile, I will show some web platforms also, and then we will close by seeing one example. Or we will see this example and then we will go for backtesting. Just this is a random idea which I got. This is not a standard strategy and all. Simply I was moving the mouse and playing with the numbers. Then whatever I learned came to some shape. This one I just tried to explain 1 year back. That time it was 21,200. What I am doing is 21,400 CE I will buy. This was around some 300 or something. Half of the premium of 300 was 500 points away. Okay, half of the premium was 500 points away. That means if you move 500 points, your premium will double. Now, what happens if Bank Nifty moves against me? Why did I sell this? I want to have a zero loss trade. So it's a heavy risk, but I want to just academic purpose, I want to study what happens. So if Bank Nifty moves up, what I will do? I am not an at the money option, I am 200 points away, okay, from Bank Nifty. So even if it grows, this will be somewhere around 0.2 delta, 0.3 delta, this will be around 0.4 delta. Let us say 0.2 and 0.4. So 100 points move, 0.4, 0.4, no problem, both will fight against each other. Beyond that, this will become 0.5, but that fellow will become 0.3. That means he will give 50 points, he will give 60 points, 10 points will be my loss. Simple multiplication. So what I did, let us buy and keep Bank Nifty 23,300 if it moves up. Okay. So now we done. Let us say Bank Nifty moved up 21,700. Now what would have happened? My premium would have doubled. That means my loss would be double. I invested whatever I invested, that will be double here. So one will nullify, one lot will give loss for me. What I do, that's why I gave already a buy on 22,300. So I will get a small debit in my account. Okay, it's okay for us, no problem. What is this looking like? Yesterday we did 2 lots, 1 lot, hedged trade, it's a ratio spread. This side with is 500, this side with is 400. The moment I cross this strike, my loss starts increasing. So I want to protect my loss, so I gave a lesser width here. I want my profits to grow, that's why I gave larger width here. If you see, I gave 500 here and 400 here. I can give 500 here and 300 here. Like that I can change this ratio. So how the payoff graph will look? This side my loss will be steep, but it will be restricted fast. My profit will go slowly, but it will go more because of this 2 lots. Now what can I do? I can book this profit, bring these 2 strikes closer, and I will buy 2 lots. Now from a ratio spread, we converted our thing into a Okay, we converted our strategy to a simple, it's a debit spread, correct? 200 points wide debit spread. So when I enter this debit spread, my net cost would be lesser when compared to directly if I enter 2100 2100 spread. That's all I want to learn from this. So this is one small game like exercise. Like this you also can keep on playing with some numbers. At one point of time you will be convinced, okay, whatever happens I'll be like chess, how you play, no? You will be, I'll make this move, I'll move this coin and keep here. Like that you do something and finally you get out without any loss or small loss, no problem. This is the idea. Now we'll go to website. Yesterday someone have, almost we have closed. Only few examples I will show you on backtesting. So I will open that.
Hello, Dr. Anish, has Dhananjay sir got disconnected?
No madam, I am connected only. I am just opening an Excel. It is taking some time.
Okay,
I just switched my window. So yesterday we had a question, where can I do the simulation? So meanwhile the Excel opens, I will show that this is the website. Here you log in. You can, I think everybody will be familiar with this only. So you can add any position. It's free login only. You can log in. Okay, the Excel got open. We'll try to understand this. So how did I make this? Just 2 minutes I'll explain you. We have half an hour more. Go to NSE website. New NSE website. In that, go to market data. In this, home, derivatives market. Here daily market reports. In this derivatives, in this you click the date. Daily reports you get here. Archives, if you go, you can go to a date, select any date. March. Here you have Bow copy, click it, it will download. That's all. Like this every day you can click and download. In that file you will have all contracts. In that Nifty alone I copy pasted here. Once I get this data ready, then I created a list of expiry dates for the past 2 years. All the expiry dates I copy pasted. So that it will be easy, which date every month, last Thursday, weekly expiry, all expiries I copy pasted the dates alone for reference. Suddenly if I want to see any data, what happened on any day, for that I copy pasted the index mixed data here, copy pasted the from 2001 to today, Nifty spot data I copied here. Nifty spot data also is available in the same website. So this is like you can click on any date. I think if it is not visible, I will maximize. If you select any date and select any expiry date, 11,500, you will get PE or CE like that. So you will get the contracts. What was the price? Just to reference, you want to refer previous historical data also. So you can refer it. Simple VLOOKUP formula only I have used. It will be easy for you to see what are the prices of open, high, low, close on this expiry on this date. Okay. This is one place where I connected all this data, and just simple, you type a price, you type a date, you get that data, and you compare it with your entry price. Entry price is whatever you fix only. This, instead of showing in table, I have represented like this. So here I give entry, exit, all these things, so that I can backtest my ideas. Now we will take any one example and we will backtest. So what was the rules which we decided for any strategy? For any strategy, bullish or bearish or whatever, choose something. This is just for idea to show you how things work. So
Dhananjay ji, one small question.
yes sir.
Hello.
Yes sir.
There's no noise, no voice actually.
Okay.
There's some problem with my system? Anybody can confirm, or it's with everybody?
No.
You're audible.
No,
Yes, sir, you are audible, but previously it was not audible.
Okay. I'll do it again. One second.
நான் கொண்டு போயிடுவேன், நான் கொடுத்துட்டு கொண்டு போயிடுவேன். 2 நிமிஷம்.
Mr. Dhananjay, are you hearing me, Dhananjay sir?
You are loud and clear, Bala sir.
Now the audio is clear, no?
No. What I wanted to request Dhananjay is, from the time you downloaded the April data,
Okay.
till you took your backtesting Excel, nothing was heard. Kindly explain. That is the vital part.
No problem, sir. Actually, while opening, I have muted. Since Excel was opening, I will again reconnect it. No problem. It's easy only.
So please repeat the audio part also, please.
Yeah, sure, sir. So you go to this website in market data, click daily market reports, and in this you go to this derivatives. Okay, derivatives, select the date, click on F&O bulk copy. That's all. Once you get all the bulk copies, copy Nifty data alone into this. Now our Raghavendra is there in our group, no? He can fetch this data in single click also. So data fetching will not be a problem. If you want to do it manually, you can do it. Okay. Next is, I have just copy pasted all the expiry data in this, so that weekly, monthly, all the expiry data we can easily access. Here just I have shown it to refer any one date you want to see what is future price, what is option price, simply I made a small VLOOKUP. This is last 20 years Nifty data. This is last 3 years weeks data, India weeks data. That's all. All these are available in that website. Like how you got to index, you can get to index also. You will get index data also. Archives. So now we can go to backtesting. So let us take any 1 month, any one strategy we'll try to backtest. You can take ironfly or iron condor, anything we can take. I'll just do it for you for any 1 month or 2 months.
Sir, please explain what are the positions taken. That is 4 wings of the fly, you please tell.
No, sorry, I am going to start from scratch. So you can enter your strikes here. This is your date, and any 1 month which you want to check. Shall we? Okay, we'll take a random month, December. From December, we are at 26/11 is our expiry. November, this is November, okay? So this is the Thursday, 14 days before. Our expiry date we can change. So this 94 I have given just to see this. Okay, 1 minute. I'll get the another Excel also I'll open. So here any week you can choose. It's getting stuck. All you have to note down is whatever concept we studied, we can take an example and just play it one by one. Yes. So we will take the expiry. Here it is expiry. You go to expiry date. You see what is the expiry you need. December month, November month, October month. November month is 93. Just go here. Check for 93. Your expiry is now 312. Here now we go to 92. 26/11 is the expiry. Now how many days before the expiry you want to start? 1 month. So I have just given a subtraction so that we can go 1 month. 28 days before we'll start. Okay. So on 29th October, what was the Nifty price? This one. Okay. On 29th October, what was the Nifty price? 11,670. So if you want to deploy an ironfly, what you should do? 11,700 CE, 11,700 PE. If you want to have a 400 points wide, you have 400.
वैसे बड़ी दिमाग खराब कर दी
400 points higher. 11,700 plus 400 is 1,200. 11,700 minus is 11,300. So this is your entry price. Paste it in entry. Okay, that's all. These things you can ignore. So we are on 29th October. Okay, now what happened next day? Just you give the next day. So next day Nifty moved by minus 28 points. Okay, from 11,670 it moved to 11,642. You got 28 points move. Your call option gave profit, your put option got loss, your buy call gave profit loss, your sell buy put gave profit. Okay, your call sold call, these two are sold. Sell 75, this is buy 75. So like this you can keep on changing the dates. Next day, half Saturday maybe, Sunday, leave it. What happened on Monday? So Monday, okay, from 11,670 only 1 point move, you got your sold option gave profit and your call option maybe VIX would have increased, you got some profit. Like this you can just change the dates and see what happened against your position. Okay, now we are testing ironfly. So whether you will keep this for the whole month, if you want to keep, you can keep, but just go through it. What is happening, you go through it. See, max loss has come 4,000. So you have a stop loss you can have, or you want to hold till expiry, you can have. If it is very less as a part of your capital, you can have, no issues. So Nifty went 1,000 points up. See, when Nifty went 1,000 points up, which is almost 75,000 move. Okay, still your loss is only 5,000. So you still hold it. Let us see what happens. Now we are 12 days left to expiry. 11 days. No pullbacks. 6 days. 5 days. 4 days. Monday. Tuesday. Wednesday. Last Thursday. That's all. So Nifty moved 1,300 points up. You started a strategy, non-directional. If you don't do any adjustments, you end up losing 6,200 rupees. This is the learning. Like this, without adjusting, you try to do it for the last 2 years. Then you will get, okay, out of 5 months, out of 10 months, I got this much. So this is the strategy's inbuilt nature. We have not done any adjustments. Now we'll try to study from where these losses came from. This loss creating position is 11,700 CE. Okay, who's fighting this PE and your bought position CE? Your long call and long put both have been trying to fight this. What happened to the PE? This fellow became 0. His direction is downside. His direction is downside. There is some noise. The direction is downwards, so your put option did not react at all for downward moves. It was upward now, so it did not react. So this is our learning. First learning, without adjustment we got loss. Why? Because it moves 1300 points. Second learning, it moved 1300 points up. Our loss creating position was our short call, and your fight helpers are long call and short put. The other person did not protect it up because the direction was upwards. Concept clear. What could have done to improve this? Now instead of two persons fighting against one person, now let us try to do small adjustments for this. For that we have to frame the rules. Okay, how we can frame rules? I'll restart from the beginning. You note down the loss as 6,000. Okay, now I'll again start the same. First day no problem, then no problem, then no problem. So I am just trying to see, he is my friend on an up move. He is my friend on an up move. He is my danger in up move. So who is fighting against this? Your put option. This fellow will dormantly fight, no problem, because his responsibility itself is to save in an up move. His person, as long as he is strong, he will help. If he became weak, what he will do? He cannot fight, no? So you just see this put option. For 142 points, your put option which gave no here. How many points? 313 by 223. So he is becoming weak. Slowly he will become weak. We don't know the direction now actually. Just as a plane. So just I am seeing this premium. If this person is almost 25% or 50% you keep. For example, 313. 50% is how much? 150. So half of his strength is gone. So how he will fight you? He will not fight, no? See, half of the strength is gone. So I am keeping a limit as adjustment 1. If any of your strikes became weak by 50% and the other strike became strong, just strengthen your weakness. Okay. Now I am strengthening my weakness. How? I am just selling this, exiting this at 83. 400 points it moved up. What is the price now? 12,120. The next call option 1200. Put option. I am now introducing now. So we have now sold a put option. Okay. Now I am going to fight with this 193. He was 83, no? Now I added strength to him, another 100 points. Now he will fight 193 points. Okay. Again we will continue the journey. What happened? 765, 1200. It will come loss also. For 80,000 investment, 5% is 1,650. Even after all brokerage, if you get 1,400 also, you can be happy. Okay, just an information. Now let us see what happens. Somebody noted down the earlier loss. No, it was around 6,000 I think. Now let us see what happens before without adjustments. Now again I will see this fellow is becoming weak or not. See, he became weak and market went up by 1000 points. He will not fight. Now suddenly if market reverses, I should not be in problem. So 1200, earlier when it went to 1200, I came 1200. Now I am afraid it may reverse. Okay, so I don't want to hedge, strict hedge. Anyway, my CE sell and CE buy will fight against each other, no problem. Only my PE alone I have to now strengthen. One time I have strengthened. Now I am strengthening slightly. So I will not go very close. So 12,700, no, I will go 12,300 points away. This is your next parameter. I will strengthen my weak PE one time. Shall I strengthen my peak PE 2 times? When I do second time, I will stay far away. All these things you have to note down. Once you note down these as a rules, you have to follow that. So from 17 I am getting 44. Only how much? 30 rupees extra. So I will go little closer. 12,500. 63. Okay. Almost 3 times. 63.15. Okay. Now I will book this at 17 rupees because my margin will get increased if I do a naked sell option. Okay. Now what happened? We'll move. Even if market retraces by 300 points back also, nothing problem. I have now 13 days left. Okay, it's Friday. Huh? Monday, holiday. Deepavali, I think. Now I am close to 1 week. Now we come to this concept. What we learned here. This delta graph which we learned yesterday. I think who asked? Anish or no, Viral sir asked, I think. Okay, the graph, I think you remember I spent some time in explaining that. This one. So this graph, now you are in this position. Whoever has to protect you, now they are weak. Okay, now protecting persons are this long PE, buy PE and this buy CE. In that this fellow, even if he weaks also no problem because we are almost 1200 points up. Now whether to continue or not, it is our decision. We got more than 5, how much? 4,000 for 80,000 is 5%, no? Have some conservative return, you just keep it or just run it, nothing to worry hereafter. Now only my profit wipes away, then only I have to think about rescheduling, or else no problem. So I will go till expiry, that's all. So previously it was 6,000 loss. By making small adjustment with our knowledge, we are able to reduce to, means luckily it came 5,000. Even if it comes 1,000, 2,000 profit also, okay, you can book and come out. Even if it comes loss also, again we have to think what to do. So this is what I want to follow. Take a strategy, backtest it for 2 years, understand what is happening. Once you are comfortable, put money and trade. Have conservative expectations. That is a summary which I want to tell. So this is where we ended. So this is one conclusion. The rules is the rope, money is the animal. If you follow the rules and strictly go, this money will always follow you. This is what my master told, whom I learned. Thank you. Any questions you can ask, and I will take up that strategy builder. Yesterday someone was asking how to do that. You can ask any questions. Just I'll go through this till any questions are open. We will just go through this. So Nifty is at 14,953, futures 14,867, spot. So how to simulate 15,000 call if I buy? We have to go buy one lot at position. 15,300 if you sell, CE, sell, add position. Here you can see margin 22,000, it may be 40,000, 50,000 also. So what is your risk, reward, everything you will get. All these are expiry day. So here you can see the Greeks. So what is the Greeks? You can see in decimals, you can see in rupees also. So in rupees, if you want to see, you can click this. That means in lots, it will multiply by the lot size and show. In decimals, if you see, it is just 48, that's 321. So any doubts you can ask?
I have a doubt, Mr. Dhananjayan. It's, you see, like I generally follow something in terms of volatility. When I sell options, I see that the volatility is high. And in case I'm buying options, I see that the volatility has to be low. So like, in case you're doing a condor and everything, what is there anything in terms of volatility that you follow?
1 minute, can you please repeat? My mic was not wrong. Can you hear, madam? Can you please repeat once?
Actually, I was asking, when I sell options,
yes,
I see the script in which I am selling options has a higher volatility.
Okay.
And in case I am buying options, I see that the volatility is low.
Okay.
In case it is the index,
Okay.
I see like if anywhere, if the VIX is near 25, 26, that is the time I would prefer to sell options.
Yes, madam.
And in case the VIX is somewhere around 18, 19, that's the time I prefer to buy options.
Yes, madam.
So in this, in terms of when you are creating a strategy like this, do you follow anything of that sort?
When I create strategy without any view, I don't see all these things. If
So
I
you
am,
don't see,
because monthly I don't know the outcome. Non-directional strategy, if it is there, like ironfly, I just put it. I keep on adjusting. Whatever is my max loss projected, I accept or I try to minimize. If I am directional, then I see IVs. And if it is event, definitely I will see. For example, 2 months once RBI policy comes. So that first week when you trade alone, you can see weekly expiry IV higher than monthly expiry or 2 weekly. So you get that IV backwardation, your calendar spread or whatever should work ideally. But if we follow rules, as you said, when IV is high only we have to go for option selling. That is like when opportunities come, we trade, make profit. But if I have to have some monthly strategy where I need 1%, 2% and all, and if I don't mind losing, then I can leave it. I will not see IV. Even if IV is low IV strategies we can prefer. Like ratio spread. Iron condor is low IV. You should not initiate actually, but we can increase the width and to make a small profit, it's okay.
Okay, thank you.
And yesterday's question was how to see the end day payoff. Okay, so this is what payoff looks 26 days before. So you see, slowly only you will get that. So next n days, okay, 2 days. After you initiate, in 2 days if you see, whatever break even it showed, no, nothing, 14,934, immediately you will get profit. But as you see, you just watch this area, 14,934, 947, 62. Slowly that shape you will get. This only I told, bending effect. See, 1553. Like that. So you can just adjust this and see. You can see the Greeks also. You can see P&L also. Any questions?
Dhananjay ji, on an average in the last year, in one of my classes, I was taught that you sell a Bank Nifty call and the put at the same time, somewhere early in the first 5 minutes of the opening of the market when the volatility is very high,
Yes.
and put 50% as of that as a stop loss.
Yes.
I apparently use that strategy a lot, and it did give me a good result.
Okay. Okay.
There were some bad days where, because of the seesaw movement, we had a stop loss set. Can we backtest the same with a smaller stop loss
Yes. Yes. Yes, sir. That and all
and
is available.
try to get a kind of a strategy which can just deliver maybe somewhere about, let's say, 1,000, 2,000 on a daily basis?
We can backtest, sir. Stock mark yesterday Anish sir was explaining. We can explain entry time, exit time, intraday entry time also we can do. Maybe Sarah is not there, but if he is there, he will brief upon this. There are platforms for that. Those will. This is just but estimating the statistics.
There is one platform which I know is Stockmark.
Yeah, stock mark
which,
only. I am also telling.
yeah. No, I'm not using it, but there are some kind of straddles which, if anybody is interested, can go and read into the Zerodha Veracity, and for the options, you get a lot of pre-tested strategies already placed there. They depends upon your financial capacity. You can take the trades, and they are well tested, and they give good results. Very soon, I will be sharing all those things with you all. Since Dhananjay sir has given you a very good brief insight, I will not be coming directly into the options and the strategies directly. I will be coming via Dhananjay sir and Dr. Anish. But I will be concentrating on whatever we are going to do with very small stop loss trades. What I'm only concentrating this time. This month we will start with the Gorilla Group. There will be some exclusions, which will be explained to the participants very soon. So we will request Dr. Anish to take up a few of the classes and how to use the stock mark for everyone.
Yes, sir. I think sir has left. We'll inform him. We'll inform to Anish sir. So, if anything else is not there, I think we can.
Dhananjay sir.
Yeah. Yes, sir.
Yeah, sir. If we deploy a strangle,
Okay.
right, and if the market is going towards the call side,
Okay.
towards up,
Okay.
so we keep on rolling the puts up,
Yes.
right,
Yes.
as adjustments.
Yes.
So till what level or till what strike price or till the sold call strike price should we roll?
You initiated a strangle, no? When you initiated the strangle, you got a combined premium, say 200, 200, 400, or 250, 250, 500. The combined premium, whatever is the distance, you sold it at 15,000 means 15,500 is your limit. That is your theoretical break even. Okay, you can roll your put as long as you roll it inside that. At least 50% of that you can roll. Beyond that, your strangle will become like an ITM strangle. So whatever 250 which you rolled out now, that 250 will be ITM money which you can't capitalize if it expires above. So whatever is the time component, that only you will be able to do it. But this type of cases, no, I'll show you this example. Now 14 cell, I'll take it off. Let us say market is at 14,900, no. So this position I will delete it. Okay, I'll reset 14,900.
Your video is not visible, Mr. Dhananjay.
Yes, share 14,900 CE cell, similarly 14,900 PE cell. So this is what you are asking, 900 CE PE cell, and this one you have to delete. This is the strangle, no? Your break even is 14,293 and 15,507. This will happen only on expiry day. If you keep it slowly towards next day, no, your break even is just very close. We are almost next end days. There is some mistake, I think. It will not be this much beautiful.
So this is straddle, I think. No, I'm talking about
straddle
out of the
only.
money option.
Okay,
Strangle.
strangle. Okay. So you sell 15,500 CE and 600 points away, 14,300 PE, like this, correct?
Right, sir.
Yeah. This you can monitor Greeks, sir. If your difference is double, you can immediately roll over. 2020, no. If this becomes 40 and this becomes 10, no, then no use. 3 times you will be losing. So you can roll over. And up to what extent you can roll over? You can roll over. You have to roll over in a different manner. For 100 points move, you move 50 points. For the next 100 points move, you move 50 plus 100, 150 points from your sold strike. For the next 100 points move, you have to move double. 150 plus 150, 300 points you have to come. Because this side your delta will be growing like anything, so you have to move it fast. 100 points jump, then 200 points jump, like that. For every 100 points you keep on moving, but at one point of time, this will become like a future. That point you cannot further handle. You have to close this and bring it to ATM. See, this is the inverted U shape. That means near term you get loss and long term you get profit. If you reverse this, you will get U shape, which means near term movements you get profit, but far term you may end up in loss. That's one thing we have to understand. So strangle during first week, long strangle and all, if you are expecting 300 to 400, you can take. This is a safe low risk long strangle.
Mr. Dhananjay, in the same strategy, you see, if the price is going to reduce below, say, 14,000, where is the black line ending? The upper.
Price is
Let's say
going to
14,300. Yes, if the price is going to go below 14,000, say, like if I want to have a cutoff, like how do you do this?
you want to limit
You buy a call, is it?
Yes, you buy put.
No.
You buy a put. You just
You buy a put at 14,000.
Yes, madam. Now if I buy a put at 14,000, no, 14,000, you buy, add position. Sorry, I think it did it. 14,000. will become like this. One side alone you will have loss, other side you will be having less loss.
Okay, if I have to balance this out again, then I buy a call at 15,600, so it is balanced.
Yes. That's again nothing but iron condor.
Oh, yeah, okay.
Normally this type of things, no madam.
And the
This
margin required is lesser compared to your normal short strangle?
margin will be highly lesser, madam. Short strangle will have more than 1.5 lakhs. Iron condor will have just 70,000 or something. I'll add now and show. This 15,800 if I add, no. See, this is how it will look like. Your margin will be somewhere around this only. If you go to the proper websites, it will may come 70,000 or something. That's all.
Okay.
But if you see the loss, it will be showing more, 1:3, but probability will be high.
No, but this doesn't make sense, right? Then you see, your risk-reward ratio is 3:1. I take a risk of approximately 3, but the reward is only 1.
Yeah.
So it's not a
Yes, madam.
profitable trade, right?
Yeah, as per risk reward, it is not profitable. In reality, this only will work. For example, if you see in the next 3 days or 4 days, this much range it will not go. So by the time if you go to 5 days to 6 days itself, you will get a small profit here, 2,000 something like that. So which is almost 2 to 3% of your capital, you come out of that. That's all. Only if you hold till expiry, and if Nifty expires beyond your break even, then only this statement will come true.
Okay.
Like normal buy sell intraday trades in cash segment, here it is slightly different. We have to travel through time. In between, if 100 times if Nifty goes up and down also, your stop loss will not be hit frequently. You can wait and you can
maximum loss.
yeah.
I understand. Yes, if there is an excess of volatility also, okay.
Now you can see this 15,000, no? Now I will just go 10 days back. See, at the same point which was showing 15,000, now it is only 8,000. So if it comes at 8,000, after waiting for 2 weeks, it's also you can exit, because once Nifty crossed this region, you do some small technical analysis which tell you it will oscillate plus or minus 500 from this point. Then no point in holding this. So loss won't come immediately also, profit won't come immediately also. Both will be slow only here. Only thing is, since I don't want to make time the market, I just take a view, and once it oscillates here plus or minus, at least if I get 1,000, 2,000 or 5,000, whatever, rate of return more than FD or something, or mutual fund if I am managing, okay. And if I want to fight, I can fight. I can sell more call spreads here. I can keep on raising the pairs. There are 7 different adjustments, rule book kind of thing for iron condor. That video I will share in the group, that you can just go to. One is without
following this strategy, I just had just one last question. Sorry. Like following this kind of strategy, what has been your trade edge? Like say you take 10 trades, what has been your success ratio?
For without adjustments in ironfly last 2 years, holding for 1 month, except 2 to 3 months, around 7 months it has given closed in profit only. 7 to 8 months. Sorry, not
okay,
2 years.
We can say like it's a 70% edge, is it?
Yes, 70%.
Okay.
But throughout the course of time, like unless you book it only, you have to consider a loss. First 3 days, 4 days it won't show loss. On second week it will show loss. Then on third week it will give profit. So my rule is I will not adjust. This is one way. The second way way is doing adjustment. So 2 lots we can trade. one lot, whatever I am telling is backtest results only, manual. I showed in Excel, no, that only manually I will click and I will do that only I have done. Real money I have not invested. I invested with only 2 months. I have just tried real. After that I didn't get chance. But this is the result. It's not that scary, madam. Actually, that's all.
Understood.
Okay, two things.
Thank you.
I have two queries, sir.
Yes, sir.
That is, just now you showed me or showed all of us that making the adjustment.
Yes, sir.
Is not too difficult a thing when you have the knowledge of how to handle the Greeks or whatever you have shown in the previous slide.
Yes, sir. Yes, sir.
So adjustment is not a very, very difficult thing. Without adjustment, you told that just if you leave it unattended, you will invariably get 70% of the times your this hedge setup will be favorable to you.
Yes, sir.
If you do adjustment with that some percentage rule you told, that how much percentage the premium has shot up or where it has lost its elasticity or rigidity, whichever we used to discuss.
Yes, sir.
I think that word was not used today, maybe because you don't want to complicate the issue. That premium also is not having much steam or something in the put option.
Yes, sir.
Reduction.
Yes, sir.
All those things are very obvious to realize and adjust,
yes,
even if you don't know the exact mathematics behind them.
Yes, sir.
If that is the case, I think your achievement of that 4% or 5% you told something, that is not very difficult thing.
Yes,
this
sir.
is
Yes,
one of my comments. Second thing is, madam was asking about volatility based adjustments. If I am not wrong, or I don't know, if I am wrong, you have to correct me. The very graph which you show is having our famous sigma values. So by following the sigma values, you can have a control or
Balasari,
clue
your
on the.
audio is cutting off. We couldn't hear you.
Oh my goodness! I think there is some issue with my internet. Then
no,
I have to
I am able
slowly.
to hear, sir. Your audio is clear. Maybe you can last 2 sentences if you want. You can reiterate.
No. Let as Murthy sir has told. Let me keep the mobiles away. Just give me 2 seconds. Now, the volatility based adjustment or whatever, we can have a clue the way you look at this graph. That is 1 plus 1 sigma minus 1 sigma plus 2 sigma minus 2 sigma. If your options are if the index is hovering around those sigmas, you can have a feel of the role played by volatility, right? And you can still do the adjustment, right?
Yes, sir. That is for range identification we can use.
No, that is, indirectly it tells about volatility, right?
Yes, sir. Yes, sir. But once your range breakouts like lower Bollinger Band breaking down, opening up, that and all happens, no? That time VIX will increase. So variations of stock price, reading that as a volatility and assessing the fear in the minds of traders is IV. So madam was telling like high IV situations, she will prefer for selling. Even when market is range bound also, due to events also, there can be IV spikes. As you said, extreme price changes, that stock volatility also we can take for taking IV based trades.
So we can consider in backtesting that number also if it, the Excel sheet allows.
Yes, sir. I will try to get that data first.
Thank you, madam, for giving this input, and we will try to see. Thank you, madam.
Yeah, but this is a great strategy, then again. For I generally prefer short strangles. Like this is a great strategy in case if the market is going to turn bear. If you are feeling that the market now, there is always a doubt in the current day, last couple of weeks. Like, is the market going through a distribution phase or an accumulation phase? So at this phase, if we use this strategy, if there is even going to be a sharp fall, I think you can uh, close your buy call and let your buy put do all the work for you.
Yes,
It's
madam.
very nice
Correct,
idea.
correct, correct. It's called a jade lizard. The actual name is jade lizard. The opposite is twisted sister. These two coin names, if you put in Google, it will come. I didn't want to put all the names and confuse because we are doing it by a rational way of selection of strikes and legs. So as you said, there is a strategy called jade lizard which does only this. It will start with a start triangle. Whichever direction goes, that side it will hedge, other side it will leave free. While hedging, it will take credit such that one portion is having no loss in that direction, other portion it will have some loss.
This is a very great insight. Thanks, Mr. Dhananjay. It's great.
Yes, madam. Thanks.
Dhananjay sir,
Yes, sir.
when we use the calendar spread,
Yes,
the
sir.
next week or next month's this thing for hedging,
Yes, sir.
mostly it would be a debit strategy, no
Yes, sir.
sir?
Yes, sir.
Then how what percentage of returns do we expect from that? Or if you want to make that into a credit strategy, then what do we make it a ratio or something?
Calendar, only call calendar, put calendar and diagonal, that's all. More than that we cannot do. The idea is you earlier, like how we discussed, no, we buy a call to reduce the margin, we sold a call. Now we are buying a call in another expiry. That's the only view. It's purely like directional only. So moment price goes to your direction, you get more profit. But why we are selling near term is the speed of premium losing in near term will be very fast. So you can start with next week and next month and this month you can take that pair and you can trade. Margin also it is very less only. So any pullbacks also you will get. Suppose 2 days down, third day up also okay. It will, that loss from your current month will be a profit for you, and immediately if it rises, all loss from your par month will immediately recover and you will be in mild profit. When you are in mild profit itself, you can start your adjustments. Without any cost expense, if you are able to move your positions to another place means that is good only.
Dhananjay sir, Vipin here.
Yeah, good evening, sir.
Good evening, sir. Sir, I have a small doubt. See, whenever we construct straddles or strangles, they say that it should be a delta neutral one.
Yes, sir.
Why is it so, sir? When you are saying that this volatility and other Greeks also coming into picture mostly, but most of them, whenever I read any books or watch many videos or something like that, they say that it should be delta neutral. What is the reason, sir? I want to just know
Delta
that.
neutral, that's why this graph I showed, no? Delta neutral means you are having a 0.5 delta that or 0.6, 0.3. This graph. You see, this delta neutral means 50% chance. That means if you have a call and put at ATM strikes, if price goes 100 points up, 50 points you will lose in call, 50 points you will gain in put. Now, the moment price moves, this neutrality will get disturbed because it will not stay 0.5. This fellow will become 0.6, other person will become 0.4. That's where your neutrality is getting misaligned. Now, for the next 100-point move, it will be totally different. They won't fight against each other. So delta neutral, why we are asking is, we want to play the game in theta and vega. That means you want to get time value erosion, you want to get Bixby credit. So when we attack at these two, we don't want to delta to come and interfere with our view. So that's why they mostly prefer delta neutral. That means they are not concerned about market's direction.
So what are your strategy now? We are saying that is iron fly, iron butterfly, everything. When we want to adjust, we have to adjust to delta neutral, sir, or not required.
Yes, ironfly, yeah, I don't see Greeks because while back testing I don't have Greeks and all. In terms of premium only I was trying to just fight. Sir, when I start the strategy, let us say this is my starting point. When I started my strategy, this is what I started, right? So, how much did I get credit? 21,000 credit, 23,000 credit, 890,000 expenditure, 23,000 is my credit. That is my max profit. It won't happen even if you keep 15,000 also okay. This 15,000 which I got credit, no, that much amount I will try to spend, means I will try to roll over. That's all. Very serious condition, very confusing conditions, you can go and refer this Greeks and all. But usually, once you start trading, means observing close, we need not be very close to the call strike on tested side. Suppose your tested side is upside, your call will be loose, no? You want to fight with put. You need not be very close. See, initially both are very close. Now once it moves, no, this OTM call will gain strength. So by staying at least 200 points away from the current market price also, still this put can do its work peacefully. That means you need not roll over every 50 points. Allow it to go. When necessary alone, you roll over. Don't worry whether it is an ITM stronger or like that. Get enough credit. Even if you roll over 2 times, if you get 40 to 50 points also, you are almost cutting your max loss. So I prefer premium and slight Greeks knowledge, that's all. If my call is giving 2 times loss, net call, that means both this call and this put. If these both are not, combined Greek is not able to fight this single call, means definitely I will start adjusting.
Sir, shall I ask one more doubt, sir?
Yeah, you can.
Sir, whenever I'm writing daily ATM straddles daily.
Okay.
So for hedging purpose, I have to keep my strategy is like from morning till the market ends.
Okay.
So for hedging, I am buying some 2 calls daily.
Okay.
To just stay the market.
Yeah, 2 put,
What,
1 call and 1 put.
Yes, sir. 1 call and 1 put, and sell 1 call and 1 put.
Yes, correct.
So daily I'm seeing that the call and put which I am buying is giving losses.
Yes, sir, definitely.
Because it is kept for a long time, and in between also it is not possible for me to cut that and buy it again because margin penalty will be there.
Yes.
So what can be the best situation, sir, in this case to avoid that losses in the calls? Any
if you are
strategy
daily going to buy calls and your objective is to gain from the theta decay means, and call is only for margin benefit means, you can take 5 rupees, 10 rupees, instead of daily taking 5 rupees OTM calls, you take permanently delivery for 1 week of next week expiry call, which will have better delta than current week, and keep it as positional. Like 10 rupees, 10 rupees, 20 rupees, 1500 rupees, you buy OTM calls and keep it on next week. And current week ATM strategy, daily 9:15 you can enter, exit, like that. Maybe I think whether this will help.
I have checked that, sir, but whenever you take a positional thing for this buying, it does not give margin benefit, sir.
In
I have checked this condition. What, sir?
In Zerodha it does like this, or in trade GD?
No. I am daily in real trade I am checking, sir.
No, sir. I am asking whether the broker is doing this or it is independent.
No. don't know. It is independent of the broker. It is happening like that. That's why I'm asking. Okay, sir. Thank you. Thank you, sir. I will find out it. Thank you.
Sir, Vibin sir, you can do one thing. You can do intraday only, but you can take the next week or the month end. You can buy.
Okay, Pradeep, I will check that.
Yeah.
Thanks, sir.
One request to all members. Sorry for the interference. The time is running out. If there are very interesting questions from people who have not yet asked the questions, one or two questions we may allow with the permission of Dhananjay and the Dr. Kamalji.
Before somebody asks a question, let me be very bring it to everybody's notices. Mr. Vibin Krishna is terrific in algo trading, and he actually must have futured the fortunes for many many of the traders. We will request him to take a class on any time next week to just give us an insight.